Hello and welcome. You're with us on a fresh new edition of the Global Reset with me, Prashant Nair, right here on CNBC TV18 Prime. This is the program where we try and explore the dynamic interplay between global events, markets, and economies. Today, we'll be speaking with Eric Johnston, Chief Equity and Macro Strategist at Cantor Fitzgerald. Eric is known for his incisive analysis on markets, stock markets, equities, that is, derivatives, investment opportunities. He's known for his insights on bond yields, macro markets, and more. But as always, before we bring in Eric for that very interesting chat, I can promise you that let's get to our guests. Let's get to our news flow and what happened over the weekend. Now, it was broadly a quieter compared to earlier weekends in the U.S. However, the U.S. President Donald Trump still had, some stuff to say about Jerome Powell, the Fed chair, and his post as the Federal Reserve chairman. The U.S. president took to Truth Social, the social media platform, to refute a Wall Street Journal report that said that the Treasury Secretary, Scott Bessent, had to intervene to keep him from firing the Fed chief. He called the story, and I quote, untruthful, adding, and I quote, people don't explain to me, I explain to them, end of quote. Meanwhile, amid the ongoing tussle between the Federal Reserve and the White House on rate cuts and renovation plans, market experts believe Federal Reserve will not be forced into making a decision as per President Trump's wishes. Here is some opinion.
Most recent data has shown an economy that seems to be very healthy. Labor markets look to me like they are, roughly at full employment. Very importantly, the equity markets are continuing to rally, so financial conditions are loosening, so to speak. The dollar is weakening, which brings inflation into the economy. So I think all the signals that I'm seeing right now are stand pat. Not clear, how restrictive we really are. And so I would very much imagine, and I think most policymakers, based on what they've been saying, are not in a mind to cut at the upcoming meeting.
It isn't helpful to have the president be so aggressively antagonistic, trying to pressure the Fed. It's not unprecedented that a president has views on monetary policy. We've seen that over time. But I think what's different about this time is that it's been pretty persistent and unrelenting. That will not change how the Fed goes about making its decisions on monetary policy. They're going to do the same kind of evaluations of the risks to the outlook, what the modal outlook is, what they believe policy should be doing to achieve the dual mandate goals. And that kind of analysis and looking at the data coming in is going to guide their decisions.
Well, meanwhile, here in Asia, Japan's ruling coalition lost its majority in the upper house election in a scenario well priced in by the market. It didn't come as a surprise. I mean, if you look at the Japanese currency, the JPY, it strengthened about 0.3% to 148.32 against the dollar. Nikkei futures were little changed. That's the reason why I'm saying it was well expected. Now, cash equity markets in Japan, that is, the cash markets are shut for trading. From Japan to China, Chinese policymakers are expected to hold the July Politburo meeting in the coming days to discuss economic policies for H2 this year. Remember, first quarter real GDP growth is averaging about 5.3% versus the around 5% growth target this year. Policymakers may reiterate their pledge to boost domestic demand and to stabilize exports, employment, and the property market. Markets expect continued policy pledges to regulate disorderly price competition and contain excessive competition. The July Politburo meeting may also announce the specific date for the fourth plenum, which is likely to happen in the fall, which will release the proposal on the 15th five-year plan for China, which is 2026 to 2030. Okay, now that's essentially the news and what has happened over the weekend out of the US and, of course, this morning out of Asia as well. Let's get to our guest now, as promised. Eric Johnston is with Cantor Fitzgerald. Eric, great to have you with us here. Thank you for waiting. Appreciate your time here on CNBC TV18 Prime. I want to start with a broader question, Eric. News, tariff-related uncertainty, all this basically is at an all-time high. But so is the S&P 500. Why is the market unbothered? How is the market sort of looking through all this uncertainty? What is driving it to remain at new all-time highs? Eric.
I think that's the view. So I think the market is looking through what the market perceives as the short-term impact from tariffs. And if you look through to 2026, there are significant favorable dynamics that we're going to see. We're going to have a likely dovish Fed governor in May of 2026. We have deregulation that will be kicking in, including in the financial sector, where you're going to see capital ratios come down. You've had all these announced investments in the US, where essentially the onshoring of production and all the investments that we've seen that have been announced, both domestically and overseas in the US. And then, of course, you have the AI build out, where you're going to see AI data center growth continue, and that's going to provide economic growth for years to come. Now, you have this short-term dynamic, which is around tariffs. And there are difference of opinions around what the actual impact from the higher tariff rates is actually going to be. And right now, the market is saying, yes, we understand it could be a hiccup. Maybe you're going to see a small uptick in inflation, a small downtick in growth, but I'm going to look through that, and we think it looks very good for 2026. So I think that's the view at the moment that the market is taking.
Eric, what is the market factoring in terms of final tariffs? From what I read, it looks like that number was between 10 to 15%, and that has been bumped up. Is it now 15 to 20% final end state US import tariffs?
So my sense is the market is factoring in the 10 to 15% range. So if you go back just a week and a half prior to this August 1st deadline, where President Trump announced the tariffs on Japan, Europe, Canada, Mexico in the 25 to 30% range. Prior to that, the market was thinking that we were going to end up at this 10% country tariff level. And then you would add on to that the sector tariffs. You would add on to that an elevated rate with China, and that you'd come into this blended rate of somewhere in the 12 to 14% range. I think things have changed over the past week, and I think, frankly, the market is a little bit complacent about this, because I believe that President Trump has become emboldened by the fact that he's already announced we have tariffs in place that are in this blended rate of around 15-ish%. You're seeing the tariff revenue flow in. The June numbers were up significantly, yet the S&P 500 is close to the highs. Economic growth has only come down marginally. Inflation is going sideways. And so I think he's emboldened by this, and that's likely going to lead to higher tariff rates than what someone would have thought just a week and a half ago. And so I think the market is thinking we're going to be in this 10 to 15% zone. And I think the risk that we're north of 15% has increased dramatically over the course of the last week.
Okay, so you're saying that the market is right now pricing for end state tariffs to be 10 to 15, but you think that number perhaps needs to move higher. So, Eric, if it does indeed settle at closer to 20%, the simple question is, will the market sell off?
I think so. So I think if we come in, certainly for the August 1st deadline, our view is that it's not going to be extended. So there could certainly be a deal or two prior to August 1st. I think that's probably a likely scenario. But there will also be major trading partners where there will not be deals, and the tariff rates that were stated in the past week will actually come to fruition on August 1st and then ultimately be negotiated lower. But I think that if in the end the blended rate is somewhere in the 20% zone, that is going to hit the market. It is going to have an impact a greater impact on inflation and economic growth over the course of the next 3 to 6 months. And so I think the market will start to discount that once we have these rates go into place on August 1st.
Okay, so markets will sell off as we get closer and closer, and the market realizes the number is not 10 to 15%, but maybe closer to 20%. Now, Eric, President Trump has said that the US is working on 5 or 6 trade deals ahead of August 1. But to quote him, he said, well, we'll probably have 2 or 3. India and South Korea are being seen as the top contenders to get a deal. I mean, and if you think about it, India really was to be one of the first to get a deal when all this started before April. It has not happened yet. Why do you think that is?
So my sense is that, I guess, taking a step back, is that I think it's been harder to get deals than the administration thought it was going to be. And I think that's part of what is leading to these August 1st elevated rates. If you look at the deals that have been announced so far, there's been a somewhat firm deal with the UK, and then there's been announced frameworks with the likes of Indonesia and Vietnam. And so, but I think it's been harder to get these deals at terms that are what the US is looking for. So agreed, based on the commentary that we've heard this week, it seems like India is a front runner to be one of those deals that happens prior to August 1st. But we've also, on the other hand, been hearing about deals to come for a long time, and there's been a lot fewer than were expected 1 to 2 months ago. So, but I do think that is likely scenario where you get a deal with India prior to August 1st, meaning sometime in the next 2 weeks, or at least a framework.
Okay, we'll see if, with regards to India, US, there is a deal or not. What about China, Eric? How do you think about that? Because that is the big one. We got that big handshake announcement over that weekend, but we've not heard anything since. What's your sense? It's really, out of all the countries, this is perhaps the most contentious.
That's the big one. And, it seems like things are thawing there. We had the announcement from the administration this week with the ability of NVIDIA to sell the H20 GPUs to China. To me, that is a sign that there is, backdoor negotiations going on, and that things are going well in those negotiations. And this was one of those pieces of the puzzle that the US was offering. And I imagine that in return, although we don't know exactly what it is, likely getting something back from China. So now the question is, okay, what happens to the tariff rate? The incremental tariff rates that we have in place this year were 10% plus the 20% fentanyl tariff, for a total of 30% country tariff incremental this year. So does that come down? I don't know. But it seems like the negotiations appear to be on a more positive path based on that announcement this week.
Eric, based on what we've spoken about so far, and your view is that maybe markets are underpricing the risk of tariffs settling higher. Is there a specific trade that you're recommending to clients?
So right now, our view is that we think equities in the short term are quite vulnerable, and that we are going to see a small reset lower in the short term, meaning in the next 1 to 2 months. And it's for the reasons, from a fundamental perspective, of tariffs that we just spoke about. I do think the market is complacent around where they're going to end up, in particular, where they're going to end up in early August. And then at the same time, there are positioning, sentiment, and technical dynamics that also are getting very extended. And our work around backtesting when we've gotten to these levels suggests that the odds of a reversion lower, a small correction lower, is fairly high. So as an example, if you look at the relative strength indicator, the S&P has gotten overbought, and it's been about 2 weeks since it first went overbought. And so we looked at the drawdowns that the market has historically gotten once you get to this RSI level. And we found that over the next 40 trading days, almost half the time you get a 3% or larger drawdown from where you were when it first crossed 70 on the RSI. If you look at the put-call ratio, the put-call ratio right now is very low because, again, there is a lot of bullish sentiment in the market. And when the put-call ratio, the 15-day moving average, has gotten this low, the last 3 times we've seen about a 4% sell-off over the course of the next 20 trading days. So we think from a from a positioning and sentiment perspective, things have gotten a little bit too extended. And then the last point I would make on this is just that from a seasonal perspective, the July 15th to October 15th window has been a tricky time for equities over the course of the last 25 years. In the last 25 years, 15 of the last 25 years, you've seen a drawdown of greater than 4%, more than half the time. So during that window from July 15th to October 15th. So this is a tricky time. It's a seasonal bottom for volatility for the VIX. So we think these factors, both fundamental and technical, suggest that in the short term, we could have a move lower, while our medium-term conviction and view is favorable.
We'll slip into a quick break here, Eric. Stay with us, though, but don't go anywhere. We're going to come right back and continue this conversation. Eric Johnston of Cantor Fitzgerald on the other side. Welcome back. You're watching the Global Reset here on CNBC TV18 Prime. We're in conversation with Eric Johnston of Cantor Fitzgerald. We, of course, have been discussing tariffs and markets. Eric, thanks very much for waiting. Let's just address the other part of markets, which I think has been spoken about quite a bit. This is the risk of President Trump asking the Fed Chair Powell to leave. What do you think are the chances of this actually coming to pass? Or do you think a lot of fire, fury, noise, but eventually, it won't happen? What's your sense?
So I think we're not out of the woods yet, meaning that there is still a chance that, based on cause, that he attempts to fire Powell. I think the odds are low. I think the odds are very low. Clearly, the back and forth that we've seen, there's been a lot of noise, a lot of conversation. We hear from President Trump about this almost every day. Having said that, I do think the odds of it actually happening are relatively low because there are a lot of dynamics around it where it doesn't actually help his cause. I think he will have to wait until May of 2026 to actually put in a new Fed chair. Having said that, I do think that there will be an announcement sometime in the coming months of who that new Fed chair will be. And I would expect that the new Fed chair, before taking the role, will be quite vocal around what he or she is planning on doing once in the seat, and that will have influence on the rates market. And so I think that will be very important. But Powell actually getting fired, I would say quite unlikely.
Eric, but his term, Fed Chair Powell's term only expires in May 2026, right? So as you say, very unlikely that he actually gets fired. But what about a shadow Fed in that sense? Basically a person is appointed much before schedule, and the market starts to listen to pronouncements from this person who is going to be the next Fed chair. How will markets react to something like this?
So I think they'll respond favorably, because ultimately, if you think about what is this new, we're going to see likely for the first time a significant coordination that's going to go on between the Treasury and the Fed. The next Fed chair is going to be likely someone who wants to lower rates. And I think that it'll go beyond just lowering the front end rates. Because if you just lower the front end rates and you don't do anything with the back end of the curve, then there's a risk that front end yields come down, but back end yields surge, with the view that you're going to see, this cause significant inflation. And so my sense is that the next Fed chair is not only going to lower rates, but is also going to try to, in some form, bring down the back end of the curve also. And I imagine that this will be verbalized over the course of time prior to taking the seat at the Fed.
For a moment, right, let's just consider the very low chance, as you say, that Fed Chair Powell is asked to go, right? Let's consider that possibility that President Trump actually asks him to leave. What about that case? What about that eventuality? However low the chance be, Eric, what's your sense? How will markets react?
So it's a great question. I think the consensus is that it would be very bad, and that the dollar would sell off meaningfully, that equities would sell off meaningfully, and bonds would sell off meaningfully. My view is that it will not be that dramatic, and I'll tell you why. But I think the initial move in equities, as an example, I think it's a short-term move lower. Probably maybe in the two-ish, maybe 2.5% type move. But I think ultimately it gets bought, because while there will be concern about Fed independence and what that means, the other side of that coin is you're speeding up the evolution to this very loose monetary policy, which risk assets are ultimately going to like a lot. And so I don't think that the drawdown that you're going to see from, if that were to happen, would be as large as as kind of consensus thinks.
Yeah, absolutely, Eric. As you said, I mean, general view is that if that were to happen, it's disaster, right? But you don't think so. That's interesting. Eric, you have a view on crypto, Bitcoin as well. Now, the Trump administration is trying to mainstream Bitcoin. I think the first federal law was signed last week by President Trump about crypto. It's a crypto bill. I mean, here in India, authorities have taken a negative view on crypto, and so have many other countries. How do you see this play out? Do you think President Trump's efforts to mainstream crypto will turn many of these countries around with regards to their own regulations around crypto?
So I do think it's going to be a material change in thinking across the world. We are quite bullish on Bitcoin. We've been very bullish for a long while now, and our view is that it has the support of the U.S. administration. You have the regulatory and legislative frameworks being put in place. We've seen a number of pieces of legislation pass in the U.S. just in the last couple weeks. You have treasury companies, public companies that are buying Bitcoin, that are increasing the demand. You have stable coins that are being announced by a number of banks that they are either going to launch or have launched. And you have a situation where based on everything that's likely to go on with the Fed, that would also be very favorable for all assets, including Bitcoin. So we think that as the U.S. takes the lead in increasing the credibility of crypto, that is going to spread around the world, and it's really going to become institutionalized, and the demand globally for it is going to rise.
Well, very, very bullish on Bitcoin without putting a price number, a target on it. Eric, thank you very much for that lovely conversation. We covered a lot of ground, the most important hot button issues as far as global markets are concerned. Really appreciate it and look forward to the next one. It's a wrap on this edition of the Global Reset. I hope you enjoyed that conversation. Thank you very much for staying with us here. More coming up on the other side.